I couldn't tell you what's happening in Manhattan, but I can tell you what's happening in Florida and Texas and Arizona, and people are making some pretty attractive purchases at a pretty big discount to replacement costs on well-located assets, because you've seen cap rates expand to, I don't know, call it 4.5 on the probably low end to 5.5, even upwards of 6. So you can get some pretty good acquisitions. And I think people that are buying right now in the next year to 2 years are really going to be rewarded here in the next 3 to 5 years.
The innovators shaping our world. I'm your host, Nicole. And today we're diving into the world of multifamily real estate investing with an industry expert joining us. His name is Charlie Keels, the head of multifamily investments at Encore Multifamily, a company that plays a significant role in reshaping real estate strategies. Charlie brings years of expertise in identifying high-growth markets, navigating construction and financing challenges, and building resilience for long-term success. Let's jump right in. Charlie, why don't we start by having you tell the audience a little about yourself? What inspired you to get into multifamily real estate and investing?
Sure. Well, first of all, thanks for having me on the show, Nicole. Greatly appreciate it. A little bit about myself. I'm based in Dallas, Texas. Been in commercial real estate for almost 25 years. Got into it. I started in commercial real estate when I was actually in college. So I was learning about how to close real estate transactions from a real estate professor, and then going to my part-time job and getting to watch them actually do it. So I worked for a healthcare developer in college and then out of college for almost 10 years. And then I got introduced to Encore Enterprises in 2008, which is where I'm at today, and transitioned from healthcare development to multifamily development in 2008, which at that time, right in the middle of the GFC, nobody really knew how tough of a recession we were going to go through. But I'll tell you, hindsight 2020 was a heck of a time to start in the multifamily business, because we've had a lot of tailwinds since 2008. 2009, 2010 were tough, but it gave us a lot of time to set up our organization and really understand the markets that we were going to pursue. Now, with multifamily, and as far as commercial real estate sector goes, I'm biased, but multifamily, what's there not to love? You got so many optionalities. First of all, you have diverse rent rolls, short-term staggered leases. We have GSE financing, Freddie, Fannie, HUD, which other property types, hospitality, office, they just don't have that availability. Then we have multiple markets. There's such a imbalance of long-term. I'll get into the short-term later on in the show, but there's such an imbalance of or need for housing in the future, and you can pivot market to market based on how the opportunities present themselves. So it's been a fun ride the past 17 years as I transitioned into multifamily, but like I say, we're just getting started there. So continue to ramp it up and hope to continue to push the volume forward in the next cycle.
Wow, that's such an inspiring journey, and thank you for sharing that. Multifamily real estate has been seeing significant changes in recent years. How have investment strategies evolved to keep up with the shifting economic landscape?
Yeah, it's been a roller coaster ride. So obviously, when people ask me that question, I say, let's go back to start of COVID, right? March 2020. Nobody really knew what was going on then, and I'm just like any business for the most part, our world kind of stopped, right? And then we got through COVID, and then the apartment demand took off like a rocket, right? I mean, the demand and the rents really went to the moon, which started a ton of apartment developments, new construction on a lot of projects. And we saw rents really increase at levels that at least I had not seen in my career on a percent, just especially in the markets we're in the Sunbelt markets, right? We saw a lot of in-migration down to the Florida, Arizona, Texas, out of some of the Northeast, Northwest markets, California, and whatnot, that created a lot of demand. And so at that point, the most active and attractive investment types were value add acquisitions and ground up multifamily development. Since then, the cap rates were at least the lowest in my careers. I mean, we were selling projects in the, depending on the market, in the, the mid 3s to mid 4 cap rates, which was unheard of in any given amount of time. But you also had interest rates that were at all time lows, which were driving a lot of that investment appetite. Since then, obviously, everybody's well aware the short term, SOFR went from, or the Fed's fund rate, SOFR went from practically zero to what, in the mid fives or so, where it peaked out at. And so we saw everything turn upside down, right? So the volume really, the transaction volume really shrunk, and cap rates really expanded. I would say, depending on the market, 100 to 200 basis points. So since then, we've seen the strategy really shift from value add development to more core plus acquisitions, because you can buy in a lot of the markets, at least that we're in, right? And we're only market experts in the markets we're in, right? I couldn't tell you what's happening in Manhattan, but I can tell you what's happening in Florida and Texas and Arizona, and people are making some pretty attractive purchases at a pretty big discount to replacement costs on well-located assets, because you've seen cap rates expand to, I don't know, call it 4.5 on the probably low end to 5.5, even upwards of 6. So you can get some pretty good acquisitions. And I think people that are buying right now in the next year to 2 years are really going to be rewarded here in the next 3 to 5 years.
Wow, that's pretty exciting news to hear, especially for the next upcoming years. What are some of the biggest challenges that you're seeing with multifamily investors facing today, and how can they stay ahead of maybe some of these challenges?
Sure. So, I mean, there's a short-term issue that I'm pretty convicted about. The supply. We have a lot of supply on multifamily. There's a lot of units under construction. That is going to subside through 2025 and 2026. We believe majority of the supply is going to be behind us. And good thing, the demands remain resilient. I mean, the demand in a lot of these markets, frankly, I thought the occupancies and the rents would have backed up more so than they had during the peak supply times. So that's short term. In a year to 18 months, that's going to be behind us. And then I think there's going to be a lot of tailwinds to really push rents, if you can, to make more attractive returns to our investors. Now, the other one's interest rates. Who knows, right? With interest rates, just when we think interest rates were heading down, and the short-term rates are heading down. Obviously, the Fed fund rates coming in, SOFR's coming in, but the 10-year Treasury has been pretty volatile. We've had which is tied to a lot of the fixed rate financing with through the agencies, which really dominate the long-term debt space in multifamily. So mid-September, we had the 10-year Treasury go down to 360-ish, and with let's call it a 1.25 buy down on your agency loan, you could get a sub 5% rate for the first time in a long time. So if you're buying at a 5 cap rate and you're locking a rate at 4.9, you get positive leverage for the first time in, 18 months, right? Wow. So we were all getting pretty optimistic. Well, fast forward to where we're at today, right? And I think the 10-year today is we're here at December the 5th is at 420-ish, somewhere around there. But it got up to 440, right? So it's gone up 80 basis points in 60 days. So that is definitely one of the biggest concerns of where interest rates are going to settle at. 'Cause the volatility creates uncertainty from the investment appetite on the sale. People don't know. Obviously the interest rates have impact on the cap rates, and so if you don't know where interest rates at least are going to settle at, you don't know where you should be buying or how to value it. It makes it more difficult.
Absolutely. I can imagine that being extremely challenging. How do you approach some of these obstacles in your own projects?
So for supply, we just starting now. We look out. Supply, there's one thing we can track is supply out for the short term. I want to say short term, 2, 3, 4 years, because we can go out and we can look at permits, we can look at zone sites, we can look at pre-con meetings with the city, zoning applications. So it takes a long time to build. I'm talking from a development perspective. It takes a long time to build. It takes you a year and a half to plan, another 2 years for construction. So anything you're starting now, you're going to be in pretty good shape, right? You're going to be leasing, and we're about to start a project in Southwest Florida. We won't start. We'll start construction actually next week, but we won't start leasing until 2026. So it feels like a pretty good time. You're going to have a lot of the supply behind you, and you'll be the newest product competing against very few lease ups. Now the interest rates are tough, right? So we do on this project I just talked about. We actually did a construction to perm fixed interest rate, and we found a moment in time where rates declined two days in a row on the long term, and we just fixed the rate. We fixed it at 5.57%, And that interest rate worked for us, right? And what I tell everybody as far as fixing interest rates is all deal specific. And if you find a rate that works for you, take it off the table, right? Because you just don't know if that rate's going to be there tomorrow, right? Or when it will be there.
Wow. So identifying the rate markets is fundamental first step. So, what are some of the high growth markets for multifamily investors? And what are some that maybe they should focus on right now?
So multifamily is all about jobs, right? So job growth, employment growth, and then wage growth, probably in that order, right? So the markets that we're really focused on, and this is not just all encompassing, but our 1, 2, 3 start with states, but Florida, Texas, and Arizona. And then in Florida, we really like Orlando and Tampa, right? Tampa's got a little bit more supply than Orlando right now, but it's just trying to find those, drilling down into those submarkets in the grander MSA that have been undersupplied. And there still are some. You just got to work harder to find them. And that set up some long-term growth potential. I mean, there's still a lot of in-migration into Florida. Florida just doesn't see the supply that Texas does. I'm sitting here in Dallas, Texas. What's there not to like about Dallas? I mean, some of the best employment growth in the country. But there's also a lot of supply here as well. So you got to find those submarkets in this 8 million plus MSA that in Dallas that sets yourself up for the best success in the future. And then Arizona, where we've always loved. Arizona's really just Phoenix for us, right?
Phoenix.
We always love Phoenix, and Phoenix has got probably more of a supply issue now than the other markets I alluded to, but it's going to be short-term as well. It'll take a little bit longer, so we're just waiting to, we want to make sure and time our deliveries right, so we'll probably wait a little bit there. But we're looking at acquisitions now in Phoenix, and all those markets are continuing to look at acquisitions. We're just very selective on what you pursue, and you got to be disciplined.
Absolutely, and that's interesting too. Thanks for breaking that down for us, especially with the high growth markets. It really seems to be key for scaling investments. How do some of the microeconomic factors like employment rates or population growth help you pinpoint promising multifamily opportunities?
It is key, right? So, I mean, we can make our business sound very complicated, but it's really not, right? I mean, it's all about jobs, right? It's job growth. If the job growth is declining, you don't need more apartments, right? Demand is going to go the other way, and you need employment growth, but also you need wage growth too, because it costs more to build apartments now. There's only a point, and I'll get into this later on, but there's trying to figure out ways to make apartments more affordable, right? Which is definitely something that I have been pushing for years, trying to find ways. I think we're making some pretty good progress, but it's all really about the job growth. Really, job growth is 1A, 1B, but then population growth and wage growth are also really important. And then you get into a lot. We track. There's actually 26 economic indicators we track, right? And we can geek out on a lot of stuff, but really that's job growth is really what you need to focus on, but not just job growth in the MSA, right? There's different parts of MSAs that could be dying, right? So you need to focus on where the growth in that MSA is going to be.
It's very fascinating perspective, and it's clear right there from what you said. Those are extremely important factors to consider. So when evaluating potential opportunities, are there any tools, resources, or methods you find particularly effective for you?
Sure. I mean, we're data junkies. We subscribe to the who's who of multifamily economists, right? And probably pay too much for a lot of the reports, but we try to triangulate and get everybody's opinion, right? But then it's ultimately up to us at that point to decide what we think is best for us and where we can gain a competitive advantage, whether that's repositioning a value add acquisition in a market that we think that there's substandard product, or same thing on our development side, or just a market right now that's oversupplied, which is, I think, probably the best investment thesis, or one of the best investment theses right now. Oversupplied, and rents are just arbitrarily low, but the real estate is just really good. But there's just too much supply that will get absorbed, and then you can definitely grow into the yield as long as you're patient, 3 to 5 years. But to answer your question, lots of economic data, just from anything from the BLS with governmental data to just really multifamily economic specific data, and then we have a proprietary model that we put together, an economic model, not a financial pro forma underwriting model that really ties everything in and ranks markets, some of the major MSAs and some markets. But look at those markets that I just outlined: Dallas, Orlando, Tampa, Phoenix, Austin, San Antonio. Usually those are always at the top, 15 in the country.
Wow. That's extremely interesting to know. So the financial landscape for real estate is constantly evolving. What trends are you currently seeing for multifamily properties?
Sure. So we're lucky in multifamily, right? Like I mentioned, we have the GSEs, right? So the GSEs are a quasi-governmental agency that their job is to provide financing to the multifamily sector. So unlike really any other property, commercial or real estate property type, they don't have access to that. So if I want a loan, I can get a rent roll and some financials or a pro forma on a development loan, and we can size it because we know their underwriting criteria in 15 minutes, right? We know about where the loan's going to size in at. So it's just we don't know where the rate's going to be, right? The rate's it moves around. The rate's the market rate. It's going to move around really daily, right? Depending on where the spreads are and whether you're locking a 5, 7, 10-year deal, it's usually an index over the underlying treasury. But you can also float too, which floating rate is going to be an index or spread over SOFR typically. So we don't see much on the underwriting standpoint change there. It's just we're seeing more people going into shorter term fixed rate debt as a whole is what I'll see is going on in the industry. I mean, typically when rates were really low, people were locking in, 10-year plus maturity, 10-year, typically you get maybe full-term IO, right? But at least 5 years IO, then a 30-year amortization balloon after 10 years. Now people are gravitating more towards a 5-year product. And the reason why is that once you lock into these fixed rate loans, you have yield maintenance associated with it because you really can't get out of it. If you can, typically it can get pretty expensive. So people want the optionality. If you're taking a view that, hey, we think rates are going to be in a better spot in 5 years, you want to have shorter term debt. But also they want to take out that floating rate risk out of it so you can fix it and then have an opportunity to refinance in 5 years. We also do HUD financing. HUD does not only affordable housing, but market rate financing, right? And so HUD did just announce in May of this year that they're going to increase their loan to value, loan to cost from 85 to 87%, and they're going to lower their DSCR from almost 118 to a 115 debt service coverage. So we'll increase leverage, nothing dramatic, but it will increase leverage somewhat.
Interesting. Okay, that's great to hear. So when we were speaking before, you were mentioning about high cost with a lot of things right now, and especially with rising construction costs and fluctuating interest rates. How should investors kind of approach managing the debt for this?
Yes. So
much.
Yeah. So first of all, you got to stay in the market, right? Stay in the market and talk to the mortgage bankers, get on the phone with the traders to try to understand I can tell you where the indexes are going, but I never know where the spreads are going. You have to get that from the traders, right? Are spreads widening? Are they shrinking? So you need to have, especially in this time, in this volatile of a market, you need to really understand where rates are at. But then also, if you find a rate that works for you, and I preach this, I said it earlier, lock the rate and take it off the table, because I've seen it go the other way. Hey, you just continue to hold out and hope rates are going to go down, and they just take off on us, right? So you have to, you got to do what's good for you and your deal, and just try not to, scrape every nickel off the table on rate, because it definitely could come back and bite you. Now, floating rate debt, usually those have rate caps associated with them. Rate caps with the decline in the short-term rates have gotten less expensive, but they're still expensive. So it's still problematic to buy rate caps. We've been trying to buy shorter-term rate caps. That strategy had worked out for us in the past, but now the yield curve has steepened a little bit, so that's backed up a little bit. Nothing material, but it has the short-term yield curve has changed a little bit against us here over the past 60 days. Similar to kind of mentioned with the 10-year Treasury move up.
Interesting. All right. So it sounds like a lot of careful planning is key here. So thank you for sharing those strategies with us.
Yes, ma'am.
So for newer investors, what advice would you give when it comes to navigating the finance options and managing risk in their first multifamily project?
So first-time investors, so the debt's just one component of it, right? First, we don't even look at debt until we understand the real estate, right? And make sure our initial screening of every project doesn't even have a debt scenario in it. It's unlevered, right? You got to make sure that the deal works unlevered, and you should only use debt as an enhancement. If debt's not helping your returns, all it does is just adding risk, especially in a negative leverage environment. So first, be prudent with debt, right? Do not take leverage and just try to maximize every dollar just to get a project done, because I think that could be a recipe for disaster. But on your first real estate deal, really understand the deal, all the risk. No, there's no perfect deal, right? Understand every risk that's associated with it, all the pros, the cons, anything that can happen. There's no way to understand 100% of it, but at least try to think of everything you can and really understand that location. All the goods and bads. Just don't show up there at 10 o'clock in the morning. Show up there, 11 o'clock at night on a Saturday, right? And see what's going on there, right? Yeah. Really understand that micro location and know everything that goes on around it, around the project, and understand your tenant base. Understand, as much diligence as you can never do too much due diligence.
Yeah. Yeah. Wow. I wish I took in some of this information that you just shared when looking at my first property, because you just wrote a lot of showed up, seeing everything. That is just some really good details right there.
If it makes you feel better. If it makes you feel better, Nicole, so do I. I wish I would have listened to my older self on my first. I think we've all stubbed our toe here and there for sure, and nobody's bulletproof. We're definitely learned from some of our sins.
Absolutely. I totally agree with you there. So resilience is key for long-term success in real estate. What are the key elements of building some resilience in multifamily investments?
So one is having a deep bench of real estate professionals that are seasoned, right? I mean, real estate, we're constantly solving problems, right? And that's really what we're here to identify the opportunities. But once you identify it, then the fun starts, right? There's always something that comes up. And so having people that on our team that have a lot of experience and are expertise in that field, right? So that's one part of it. But then also putting together an organization that can transition as opportunities present themselves, whether that's development. We've done a lot of development, right? Development's very tough. We're still doing development now, but we're more selective on it. So you need to be able to pivot your your investment strategy from development to core plus to value add to keep that perpetual resilient company going. And then multiple markets as well. I mean, if you're in one market and only understand one market, then that market could change, right? So you need to understand that different markets present themselves and always now you can't understand every market. I mean, real estate is still a locals game. I think you can definitely get yourself you got to figure out a set of markets that you really understand and make sure you understand them well and be able to pivot to where you think to the market that sees that presents the best opportunities.
Wow. That's some valuable insight, and it really does seem that resilience is key for seeking some of these successful projects. Can you share an example where resilient strategies helped you navigate a particular challenging situation?
Sure. So, probably top of mind, we've mentioned construction costs, COVID, and construction in the middle of COVID was very, very difficult, right? In 2021, really the first half of 2021, we saw lumber. Most apartments are built, at least down in the Sun Belt, with the exception of a few Florida markets that we're in, are built with wood frame construction.
Okay.
So we saw lumber go from historically 300 to 400 per. They price it on per thousand board feet. So 300 to 400 per thousand board foot. In I believe it was May of 2021, Nicole. It got up to 1,600, right, in a very short amount of time. So it roughly quadrupled, right? And that was just one issue. The second issue was getting lumber, right? Getting lumber. So we had contracts with vendors that were just saying, hey, we can't honor it, right? So we're under construction. The worst thing you can do once you start construction is stop construction. You have to keep the train moving. So we were able to resource around with our regional general contractors. The gentleman at Encore Enterprises that runs our construction group, was actually hired number one. Has been here 25 years and knows more about construction, or forgot more about construction than I'll ever know. Right? He's just incredible, and he did a tremendous job. First of all, making sure we got the lumber that we needed to the sites without stopping construction, but also knowing the lumber market's a lot better than I do, and saying, hey, we don't want to lock in for the whole project right now. Now, nobody has a crystal ball, but we pushed off buying at the peak times, pushed it off about 6 months. So we were able to get the little lumber we needed to keep the project going, but survive the peak run up. And so it ended up working well for us. Very stressful time. They don't always work out like that. It could have continued to gone up, right? We took a gamble, but we took it was an educated risk for sure that worked out for us and our investors, and definitely our investment partner in Knight Investment. So.
Wow, absolutely. And it sounds like that individual that you guys have on your team was extremely valuable with trying to figure out the routes that you guys can go with lumber.
Yeah, that's what I want. That's what I want to say his name, so I don't have any recruiters come and try to track him down.
No.
I'm kidding. No, he's great. So we couldn't do it without him.
Definitely sounds it. So what are some proactive steps should investors take to safeguard their portfolios against economic uncertainties, like just spoken about before?
Now you've heard me say fixed debt a lot of times. I mean, fixing debt makes you sleep better at night. But it all depends on what you want. If you're a long-term holder, right, the fixed debt, put it to bed so you don't have to worry about, your interest rate changing all the time or having to buy hedges into the market to cap that. As well, try not to just get too far out over your skis, right? Not to, don't always tell investors, diversify, invest in multiple cycles of the market. Nobody knows if anybody tells you they know for sure where this is going to happen, where this is going to go, we're not, right? We take a lot of educated guess, do as much research. So invest in the up cycles, the down cycles. Don't put all your eggs in one basket. Don't put all your eggs in one sponsor. Don't put all your eggs in one market either, right? And do your diligence on the sponsors that you're investing with, and a lot of folks that, like most of our investors, right? They're passive investors. They invest with us through our investment partner, Ignite. And because they're busy doing their own stuff, right? So they don't have they can rely on us to go do all the diligence and manage the interest rates and manage their investment for them, which has historically worked out. I mean, to date, even through this crazy time, we've never cash called any of our investors in our 27-year history, I believe, which is
that's amazing.
Knock on wood. Yeah.
Yes, knocking on wood. So you spoke about diversifying. Mm-hmm. Looking ahead, what kind of trends do you see shaping the future of multifamily real estate over maybe the next decade?
Sure. So long term, when I say long term, say 20 years, right? We definitely see that there's going to be a need for housing, right? Overall, in the interim, the next year we got a supply demand imbalance, but that's short term. It's definitely there's a need for housing. So there's development's got to happen, right? There's got to be more ways to develop, but the problem is making a lot of those numbers pencil with the construction cost and the yield that you need to justify the construction risk has been problematic. So developers like ourselves, we've gotten really aggressive on design efficiencies, figuring out ways to really just standardize the product. And when I say standardize the product, it's not like making a widget, right? We try to make a project that looks good in every market that our tenants are proud to live in. But design a project that's sufficient to build cut out the amenities. I mean, we were over amenitizing some of these projects. It's my personal opinion. So cut out the amenities that our tenants don't use, right? Because whether they use them or not, they're paying for them or rent, right? Because it costs us to build these. So cut out the amenities that our tenants don't want, and hopefully cut the cost down, and then cut the rents down, right? Our goal is to try to find a way to deliver an affordable product that can appeal to the masses, that 80 to 100% AMI, and that's really what we've been focused on here recently. And I think there's going to be a lot of the trend. And we're making a lot of good steps there, and I hope to continue to do that. I mean, it's definitely something I'm convicted about in the long term.
Wow. Well, it sounds pretty exciting to hear too, for affordable type of places where individuals are able to see, especially in the near future. With more competition entering the space, how do you ensure Encore Multifamily stays ahead of the curve?
That's always tough, right? We say more competition. Do you mean more multifamily investment sponsors, operators, developer? Yeah, we've seen a lot of that. As other asset classes, office, let's say, have gone out of favor, we've seen some of those guys come into our space. And look, we welcome the competition, right? We just stay disciplined, and that's what you have to do is just stay disciplined and make sure that you're not forcing any projects, and that's what we continue to do. I mean, whenever projects start to pencil, we'll do as many projects as we can make pencil. I'll tell you, we're closing a project next week, Nicole, for the first time in 2 years. That's how disciplined we're just nothing would pencil, right? I mean, so take that into retrospect. I mean, typically we're closing, half a dozen projects a year, right? That are, $50 to $100 million a piece. So now we've been pencils down for a while just because we couldn't make a lot pencil. But now and that's a discipline you got to have too. And that you can't just force investments. We're obviously fiduciaries to our investors. We want to make sure that we're a good steward of their capital.
Absolutely. So for someone just entering the multifamily space, what advice would you give them to ensure that they are definitely set up for success?
Well, as somebody told me when I was first starting into this business, location, right? And it still prevails, right? It is all about as cliche as that sounds, it is all about in real estate world is all about location. Make sure you understand your location. Make sure that your location is set up for success long term, right? And then patience. Typically, you go back and you do a lot of research on the most successful real estate owner operators in the United States, and they're patient. They're patient investors, and typically in this business, if you're patient, you'll be rewarded. And don't try to force anything. I've seen some really bad stuff happen when people try to force projects. Be prudent with leverage, really focus on your location, and just patience.
Okay, that's good to hear. That's very good advice to hear, and I hope the audience takes that into consideration as well. So to wrap this up, let's end it on a fun note. If you could design a dream multifamily development anywhere in the world, where would it be, and what would make it unique?
Anywhere in the world, huh? I don't know. That's a good question. Anywhere in the world, just putting returns aside, and
It's your dream multifamily.
I guess dream multifamily. I would never do this because the return standpoint, but it would always be fun to develop something Manhattan or something like that, right? But it's definitely not anything with that as a locals game in that world. Is something that we would we happily will bow out of, but something along those lines would be it'd be pretty cool to get something to do one of those deals. But we just stay in our lane, right? We just try to develop stuff that appeals to the masses. Stay out of typically the top 1% renter base and try to appeal to that 80, 120 AMI that a lot of our tenant profile can afford.
Awesome. Well, thank you so much for that response. Charlie, for people that are looking to find out more information about yourself, Encore Multifamily, are you able to provide some details so they can see?
Yeah, absolutely. So you can go to our website, www.encore.bz. That's our Encore does a lot of things. I head up our multifamily silo. or also go to igniteinvestments.com, and that is our investment group. Where if you're looking for any investments, you can definitely go there and fill out some the contact us form on the website, and they'll be able to get you any information you need or answer any questions you have.
Great. Charlie, thank you so much for sharing your expertise today, your insights into multifamily investing, as well as your thoughtful approach to navigating challenges have been incredibly enlightening. For our audience, if you're looking to learn more about Charlie on for multifamily, he just provided the website, and we will have the website in our description detailed below. Thank you again, Charlie, for being part of Only the Savvy. We look forward to seeing all the new exciting projects bring to life this future. Don't forget to hit that like button, notification bell, drop any comments below. Hi, everyone.